Hey everyone, and welcome to another episode of Cash Talk. Today, I'm joined by investment specialist and director of Firetrail, Kyle Macintyre. Kyle is the investment director at Firetrail Investments. Firetrail is an investment management. It's a boutique founded in 2018 and specialises in high conviction investing. Kyle's primary responsibility at Firetrail is providing investment and portfolio insights to professional investors. Kyle is an MBA graduate with over 10 years of relevant investment and SME experience. Kyle, thank you for joining us today at a very, very topical time about investments and equities.
Thanks, John. I'm happy to be here.
That's it, mate. Now, Kyle, obviously, I know a little bit about you, and obviously your rap sheet talks for itself. But at the moment, you're probably, looking around. It just feels like all the rocks are moving at the moment. We've got interest rates all over the place. We've got, inflation talks. We've got China's property market. We've got even BHP coming to a sole listing. We've got, Russia potentially, invading Ukraine. There's a lot of stuff happening. But before we get into the particulars of those items, you must love this in a way as well too. So how'd you get into where you are today? Yeah, and why do you love doing what you're doing?
Yeah, spot on, John. I absolutely love what we do, and it's definitely volatile out there at the moment, but that is very exciting from a stock selection standpoint. And as an active investment manager, it just throws up opportunities. I suppose, if I think about my history, I actually didn't start out in investment management. Prior to this, I was in cloud computing. So in a very different industry, doing different things, helping governments, schools, large organizations basically get their organization onto the cloud. We had a small cloud computing business, and we were looking to sell that business. We were being acquired. So I needed to think about what I was going to do next. And during my MBA, I'd actually really fallen in love with behavioral finance. I think an investor's behavior can be one of the key determinants of their success, particularly during trying times like we're seeing at the moment and periods of volatility. So I loved reading, guys like Danny Kahneman and Amos Tversky, who talk a lot about behavioral finance and how people make irrational investment decisions. I'm also very competitive. I played a lot of sport, going through school, going through university at a competitive level. So I love the fact that this is an industry where you can win, and it's highly competitive. If I think about, how many teams are there in the AFL, John?
There's too many these days. I've lost track. I think 18 or something. Yeah,
that's about right. I thought it was 18 or 20. If you think about my sport, managing funds, there's over 200 investment managers here in Australia. So hyper competitive. Everyone's trying to win. Everyone's trying to beat their competitors and beat the index. And I absolutely love that sort of high performance environment. So I took that. I took the stuff that I'd learned through my MBA, and I decided to join Macquarie with the rest of the team and who started Firetrail. And we all loved working together at Macquarie. We're doing exactly the same thing as what we're doing here, building high conviction portfolios of our best ideas. And then we decided that we just wanted to do it all together and lock ourselves in. We've got a great team, a great culture. And the key thing that was missing was that equity partnership, that equity alignment amongst us all. And so in 2018, we started Firetrail. But that's a bit of my background. The reason I love coming into work every day, number one, it's the people. I work with really smart people, way smarter than me, which I really, really like. Number two, real high intensity that we've got here, and that high performance sort of environment. And number three, you're always being humbled when you're investing. You're always learning. You're always putting into practice those different disciplines that I've learned both through my career and also through my study. And you're always coming up to new challenges, like what we're seeing in the current market environment. So it's a really exciting industry, and I absolutely love coming into work every day.
It's great to hear that, and I hear your excitement. I can hear your passion coming across, and for me and for everyone that knows me, I absolutely love what I do. And I say that in a way, I feel like I'm not even working, to be honest with you, Kyle. It's yes, I get paid for what I do, but getting out of bed and changing people's lives and changing their kids' lives and their grandkids' lives forever is an amazing thing that I do. And those high five moments where we're able to achieve their goals together, just, is absolutely amazing. So to share, the platform here today with someone so passionate is very good. And I love it. One of the things you say, Kyle, is around behavioral, finance and behavioral investing. And people may think I'm mad, but, if I'm on a beach on Fiji in a COVID-free world, and I've got my pina colada or whatever's going at the time, I'm reading behavioral finance and behavioral investing. That's how much I love it as well too. And I've realized that we can't control the stock market, but we can control how we react to it. Okay. Yes. And so controlling ourselves, our behaviors, our emotions are very important. And you spoke about this elite team that you work with, and obviously, I don't even like to put myself anywhere near that, but I felt my most successful investing is where I have my emotions really in check, and I'm making logical decisions. And I can relate to obviously the March 2020 period personally for myself. Some of the best investments that I made were that now that we know that was the bottom of the market. Obviously, hindsight's a great thing, but I remember saying to my wife when I pulled the triggers on some decent size investments personally, I remember the one thing that I did say to her, that I feel relatively calm and I feel relatively at peace. Yeah. And with all the chaos that's going around me, the analogy that I had was that trained soldier who's more nervous on the flight over to the front line than when he's actually on the front line. And that's obviously, I've been in the industry for now, nearly 20 years. I'm 33 as we do this recording. So, I've been more in finance than I've been out of finance. So I'm probably well conditioned. But for the likes of you and your team and emotions and what you practice, how much goes into that? And obviously, let's talk about, the emotional side of investing and what you guys do to keep that in check.
Yeah, for sure. It's funny that you mentioned March 2020 because I actually remember one of our co-lead portfolio managers and the managing director and founder of Firetrail, Patrick Hodgins. They don't come much more experienced than him. He's been in markets for 35 years, 28 years as the head of equities at Macquarie. So really, really experienced guy. And in March, we're in the thick of it. And you should have seen the smile on Patrick Hodgins' face during March 2020. And he just said to myself and the rest of the team, you get these opportunities once every 7 to 10 years to buy businesses like Xero, the cloud accounting platform, at $60 a share, 50% off where it was just a couple of weeks before, to buy really high quality businesses at fire sale prices. And he said, you won't see these opportunities forever, but I tell you what, if you don't take advantage of them, they don't come around often enough. So let's get into it. And he was like a kid in a candy store. And so we really turned our portfolio around quite aggressively during that period, buying some really high quality businesses, but also buying businesses that the market thought were down and out, companies like Qantas during the period, Qantas at the height of the pandemic, people were questioning whether or not we'd be flying again. And, since then, Qantas was trading at around $2 a share. Today it's at $6 a share. So, some really strong opportunities. And the only way you can make those decisions is to be rational and to focus on the underlying earnings of a business and to focus into the future. At Firetrail, we look out roughly 3 to 5 years when we're going to make an investment. We have a process where we call it focusing on what matters. So we really look into the future and say, what's going to drive the underlying earnings and the share price of this business over the next 3 to 5 years. And then we stay very disciplined on valuation as well. So, using something like Qantas as an example, in March 2020, things were dire and people were saying, are we going to travel again? But taking a step back, we actually said, well, we've been through periods where people question travel before. We've been through the GFC when Zoom and video conference calls, not Zoom in particular, but video conferencing was huge. And people were saying, no one's ever going to travel internationally again. And then we saw as things start to open back up, everyone started to. So the question for us was, can Qantas come back from this? What does it look like over the next 3 years? And then we really dug into what's going to drive the future profitability for Qantas. And something that was really interesting when we actually did the research was that 85% of their earnings come from their domestic business. So from the domestic aviation business and also the Qantas frequent flyer business, and less than 15% of their earnings in FY19, a record profitability year for Qantas, was in the international business. Now, when you can put international travel to one side and really focus on the domestic drivers, things didn't look too bad because we were putting things in place to isolate Australia from the rest of the world. We were putting things in place to make sure that Australians could start to travel at least within a domestic bubble. And when you think about the competitive environment in the domestic aviation market, there are only two competitors. There's Qantas and Virgin. So that's actually a really attractive industry structure because you don't have a lot of competition. And Qantas and Virgin were also using this as an opportunity to take costs out of their business and really focus on future profitability. So, just to not labor on it, but when we put it all together, we actually thought, well, looking out to FY23, FY24, because of the domestic business and because of the rational competitive environment between Qantas and Virgin, we actually believe in FY24 they could have a record profitability year driven by the domestic business. The Qantas frequent flyer business was doing fine. Their key customers like Woolworths and some of the key supermarket chains and some of the key retail chains were actually doing really well. One thing people were buying was things like toilet paper, stocking up the fridges, stocking up the houses, and people were buying a lot of electrical goods. And every time you do that, Qantas makes money from their Qantas frequent flyer program every time you spend $1 at Woolies, as an example. So that business was doing really, really well. And we were able to buy it at a huge discount as well. As I mentioned, trading at close to $2 and trading back at $6 today. Qantas still looks cheap today when we look at it on valuation metrics like a price to earnings ratio or whatever it is. But that's just one example of staying rational and actually looking at what's going on in the market right now and saying, well, this is happening for you. This is an opportunity to buy these businesses at a discount. Let's go and do the work and see whether there's an investment opportunity over the next few years.
And Kyle, so let's talk about those. So we're talking about, obviously, even now at the moment, you see the stock market falling. You see your current portfolios obviously being affected. Prices on these assets are decreasing, some at a rapid rate. When we talk about March 2020, it was absolutely at, I hate using the word, but reality, unprecedented, rates. Today, we're obviously seeing some falls that are happening in the last month. And, the heart rate starts to get faster. Yeah. And I think from my thoughts, obviously the difference between the novice and the amateur is that heartbeat goes a little bit quicker. And it's like that trained athlete. Okay. And so maybe what can we, and that's really great, that conviction, but when you're looking at those things, how are you keeping your emotions in check? And maybe does your team practice anything to maybe keep their emotions in check? Because for the people who are novice or the mums and dads or, the average, Joe Blow who's listening to maybe this, sometimes their emotions are getting in the way of making, great decisions like you did with, some of the ones we just talked about.
There's a couple of things there, John. Number one, everything we do is team-based at Firetrail. And so it's not one investor making all the decisions and potentially making an irrational call. And so, we run teams of portfolio managers. We've got a team of 20 here at Firetrail. The analysts are all part of the investment committee and we're all making decisions as a team. And so what that does is it puts a lot of checks and balances in place as a starting point when you go to make an investment decision. The second thing is, during periods where things are volatile and things are stressful, from a personal level, you find that a lot of the team will increase their amount of health practices. So ensuring that they're staying active, ensuring that you're getting your training in and just making sure that you're getting those moments so that you can think clearly. And number three, we always come back to our process, which is, every company has a price. A lot of the time, these dislocations can be investment opportunities to find companies that are trading at discounts. And number two, let's focus on what matters, which is doing the research, what's going to drive the earnings and the share price into the future. And if you can take that longer term view when you're investing, these periods in markets can actually be great investment opportunities, like what you saw during March 2020. That's it. Just stay disciplined, stay focused, and really focus on what matters and what's gonna make a difference to your returns into the future for your investors.
So one of the things I hear you saying in the most simplest term is stick to the plan. And we
Stick to the plan.
And we say this all the time, and it's sometimes very boring. It's just stick to the plan. Stick to the plan, and
that's
and have your investment decisions based on logic and not on emotion, because it's emotion that's driving you away from the logical decisions. When everyone knows, when you look at a stock and it's 40% off, it's cheaper than it was, before. It's more logical for you to buy it, But yet, when you're seeing the news and you're reading the newspapers and there's bloodshed on the newspapers, most people are running away. And, as some of the greatest investors of all time have repeated over time, and I think it was John D. Rockefeller when it said, when there's bloodshed on the newspapers, it's time to invest. And, when you think about that, we're not talking about people who made, a penny or two. We're talking about the greatest, investors of all time, or greatest businessmen of all time, telling us the, secret herbs and spices. Stick to the plan, get your emotions in check. And you're hearing it once again, everyone, from Kyle as well, too, and his team. Stick to the plan, stick to the process. And that's what we believe in, to keep your emotions in check. Now, in saying that, go.
Oh, the other thing I was just going to say there, John, is, in our portfolios, we remain fully invested. I see a lot of investors, trying to time going into cash and equities. Very, very hard to do, almost impossible to do consistently through time. Statistically, in the last 20 years, for you to have picked, the selling points and the re-entry points for every major drop over 10% in the last 20 years, your odds are less than 1 in a billion. So very, very hard to do. But I tell you what, we have learned over, running the High Conviction Fund for the last 16, 17 years, we've learned that if you build a portfolio of your very best ideas and stay invested and think about the long term, that will generate outperformance for you and for your clients. So, that is what we always come back to is, in your words, stick to the plan. For us, stick to the process, maintain conviction, and just keep going through it. It doesn't mean we always get it right. Some years, aren't as good as others. But what we've found over time, over a rolling 3 to 5 year period, is that, if we do that consistently through time, we will be adding value for you and your clients. So we just stick to it.
I agree. And mate, trying to time the market is very, very hard to do. Okay, it's extremely hard to do. And, and once again, we only have to refer to, some of the greatest investors of all time, warning us about timing the market. You don't need to. It's about staying invested for the long term. I think, Kyle, one of the things as well, too, is that when you're entering into the market, not just buying crap as well, too. And I think this is the other thing, is that we're on the way up, you can buy crap and it's going to look good because, mate, in an upward market, you could, sorry my French, but, you could throw, shit on the wall and it could turn into gold. Yeah. That's not what we want. Yeah. We want to be buying quality assets that we know, regardless of what's going to happen, the entry point is going to remain a good price in the position that we've positioned in. So then if things go down south, well, hang on a second, we're still holding these quality assets and we're not willing to get rid of them. And the analogy for Australians that's most closest to them is, when you buy a house, you don't buy the crappiest house in the crappiest street. You try and buy the best, the best location. You might not be the best house, but, potential renovate. Well, in stock market, you can't renovate it. So you want to buy the best house in the best location at the cheapest price. And that's what we're trying to do here, so that we're constantly holding quality assets. And even the names that you talked about before, when you talk about Xero, you talk about Qantas, these are not companies that are, Joe Blow's tackle shop down the street. We're talking about quality companies who are going to withstand a lot of thunderstorms, that could come their way.
And I think you touched on a really important point there. Focus on the price you pay as well. Going back to your house analogy, you could have the nicest house in the nicest street, looking out over the water. If you pay $1 billion for that house, it's going to be a bad investment. I guarantee you it'll be the worst investment that you make. So, focusing on the price is absolutely key as well. And when people go to buy a house, they do their research. They look at what the quality of the asset, they look at what it's worth, and no one wants to overpay for anything. It's really funny in investing in shares, which are just companies. I see all the time people wanting to pay more and more for businesses and not maintaining that same discipline that you would when you're going to buy a house. That's something that I always think about when we're investing, is focus on the price and make sure you're getting in at an attractive entry point to give you that margin of safety.
Beautiful. Well said. Well said. Now, one of the things that we've tried not to focus on is a lot of the noise that comes through. And obviously, I'm a believer that the more noise you consume, the more your emotions just drive up. But there's a lot of noise at the moment. And if you can help me just unpack some of this stuff and maybe what's Firetrail's view on some of this stuff, we can maybe start to create a little bit of clarity for most people. And there's a few ones, but I just want to start with obviously one of the ones that isn't news and not news to many people, and that's around inflation and interest rates. Obviously, there's been a lot of money printing happening, a lot of QE happening, over the last couple of years. And, even just, I think it was this morning, the US Fed kind of come out and said, listen, we're holding for now, but, come next month or come by March, interest rates are going to be increasing. So, with that said, what's the inflation look like, interest rates, and the impacts on equities, both locally and maybe abroad?
Yeah, for sure. I mean, there's a few things to unpack there. Number one is inflation is real. It affects you and I, and it affects the price that we pay for goods and services. When we talk to companies, it gives us a really good gauge of whether or not there's going to be inflation coming through, because what you see is that these businesses, as a starting point, are purchasing raw materials, goods, etc., to create products. And what we saw 18 to 24 months ago was that the Purchasing Manufacturers Index was going up, which is basically how much companies are paying for raw materials. And so that is a really good lead indicator for inflation starting to come through, because when companies are paying more for raw materials or more for labor, chances are they're going to want to pass those costs through to the underlying consumer with higher prices for goods and services. Now, if they're not able to do that, then obviously it impacts their earnings, it impacts their earnings margins, and that'll affect the share price. And what we've seen over the last, call it 18 months, is the amount that these companies have been paying has been increasing, and broadly demand's been so strong because of some of the things you were talking about before, John. We've had all this stimulus pumped into the system. We've had all this fiscal and monetary policy that's been expansive and has been helping us. What it's done is it's raised demand for particularly for goods. You look at the amount of TVs people are buying, the amount of renovations going on. People are buying new homes, asset prices are high, so people are feeling wealthy, and so companies have been able to pass that through to consumers, and that's resulted in the consumer price index going up and inflation coming through. Now, when that starts to happen consistently through time, what it actually means is the economy's really starting to get hot. And what you don't want is inflation to run so high, particularly too high above wage growth, because then people like you and me become worse off. If the price of everything is going up 7 or 8% and the price of wages are only going up 4 or 5%, that's the example that we've got live over the last year. You and I are actually 3% worse off, even though wage growth is actually really strong. And so inflation is an issue for everyone. It's an issue for investors, and it's an issue for economies. And so central banks want to be able to control inflation and get it down lower, so that the price of goods isn't getting out of control and people aren't getting poorer year in, year out. You can imagine if inflation was to run at 7% for the next 10 years, everything would be worth double what it is today. You'd be paying double for the price of milk, double for petrol, etc. And that just isn't sustainable. And so one of the policy tools that central banks have to control inflation is to actually start to increase the cost of borrowing, and start to increase the cost of borrowing for corporates, for governments, and also for your home, and really start to slow down that growth that has caused inflation to get out of control. Now, it's really tricky because when you start to change interest rates and when you start to change bond yields, what it actually does is it impacts the valuation of different assets. It impacts the valuation of your home, obviously, because the repayments that you're making on your home start to increase as rates go up. And it also impacts the valuation of things like equities, because things like cash, term deposits, etc., become more attractive relative to things like equities. So it's all interlinked in terms of valuation. And so, the key for a central banker, what they're trying to do right now is to say, okay, well, let's raise rates so that inflation doesn't continue to be out of control. Some of these inflationary pressures will roll off as well. We've got supply chain issues, we've got freight issues at the moment. Over time, they will resolve themselves. But let's do it in a way that we're not going to have a massive impact on asset valuations, and we're not going to have a massive impact on demand as well. So it's a real balancing act. And right now, what markets are saying is the Fed going to get this balancing act right? Are they going to raise rates too quickly, and then people will start to tighten their belt, and so you'll see a fall in demand? But also, if you don't raise rates now, will inflation get out of control? So it's a real tightrope that they're looking to walk, and it's impacting asset valuations across different markets.
I think as well too, the equity markets are very good in pricing these things. And,
Yes.
I've learned over a long, long time that, what you're seeing today is based on a lead up to this event. It's
Correct.
not as in, oh my gosh, this is already, going to, this is going to happen in 2 or 3 months. Like the Fed talking today, I think there was an a day change of about 2.5% on the S&P 500 just alone, and just to understand how things react as quickly. But this news about inflation and about interest rates is no news. Well, definitely not to people like us anyway. We talk about this sheer level of money printing is huge. But the balancing act that Kyle's talking about, and it's around, are they going to get it right? And markets don't like uncertainty. Markets like certainty. It's all about how certain things happen. And usually if they're certain, you will see, green on your screens. If you see uncertainty, you will see, red on your screens. But once again, this is where opportunities are presented, because it's this whole greed and fear factor and these emotions of these people transacting on these stock markets that are creating opportunities. And I think the other one
hit the nail. Oh, sorry. No, you go. You go.
No,
I was going to say you've hit the nail on the head, John. It's expectations are key when you're investing. And so, right now, to your point, the market is expecting the Fed to raise rates 3, potentially 4 times over the next year. And that's being priced in right now into the market. So the fact that they're going to do it is already priced into the market. The key question is, are they going to do it faster or slower than what the market expects, and the market will react to that? It's the same when you're valuing a company or doing work on a company. If a company says earnings growth is going to be 10% next year, and they come in and deliver 8%, that's a 20% downgrade to where the expectations were, and the share price would fall on the back of that. So you've hit the nail on the head. Expectations are absolutely key when you're investing, and right now what the Fed is navigating is expectations, which is why their communication is so key when they're talking to the market about these different things.
And I think, to put this even in greater perspective, if you think about some of the greatest short-term crashes that we've seen on the market, it's because of high levels of unexpectancy. And you have to look at the September 11 terrorist attack. Have a look at what happened to the stock market when they heard about 2 planes going into the World Trade Centers, and obviously then the Pentagon and whatnot. Markets plummeted. It's the market doesn't like uncertainty. And obviously when we talk about the whole March 2020 and that deep dive that happened, or if you look at it, kind of looks like a brick wall, it's unexpected. No one expected governments to start just locking down places, and literally locking down economies. So but I think the inflation and interest rate kind of situation that we find ourselves in is more of an expected one. But once again, what we're seeing at the moment is a lot of this already kind of into the markets as well. One of the ones that isn't so popular, maybe domestically speaking, but maybe is one that's of interest to me, and a lot of talk that I have, is around the Chinese property market issues. Obviously, there's a lot of talk about the Evergrande, but there's other major property developers and that are having issues. And I was reading this morning that, just so people can put this in perspective, there's the amount of empty buildings that are built by these developers is about 27 times the amount of New York City. So there was ranges, and I hate talking about it because I feel like the information is incorrect. Okay, but we were talking about some debt levels into the 100, and I think it was like 116 trillion. One of these guys was saying, which was like ridiculous levels. If you guys think about that, that's like 10 times more than some countries that are out there in regards to how much we're talking in regards to debt. And, we're talking about, there's a lot of speculation. And I think when it comes to China alone, the information that's coming out of the country is very sketchy to say. But, talking about the Chinese issue in regards to the property issue, and then just obviously the economy overall, because, the weight that she has on the local economy and then the international economies. What's Firetrail's view on this, and how do you see this, potentially playing out?
Yeah, for sure. Well, John, prior to the pandemic, we'd get out to China every quarter because, to your point, you want to see what's actually going on. And one of the things that sticks in my mind is just seeing these photos of these empty cities you're talking about, these cities just waiting for people to move in. And they're sort of ghost towns as you go through them. I suppose to put that into context, though, you got to think about the sheer volume that we're dealing with. You're dealing with such a large population who's starting to urbanize that without planning this beforehand and building these cities beforehand, it would actually be very, very hard for them to transition their economy from a rural-based economy. They're obviously going through a period of urbanization, and so a lot of it is planning. But to your point, things have slowed down in China. We estimate the Chinese economy, roughly 70% of their economy is linked to their property market. So it is huge. Like when you look at the second and third derivatives, you're talking massive exposure to property in the Chinese market. And so as a result of that, I don't believe Xi and their government would allow a hard landing for the Chinese property market. And so let me give you a really interesting snippet from overnight. There was a sale of $180 million worth of land, of government land in China, that was actually used to pay down debt, and it was actually bought by state-owned enterprises. So basically, the government has land and they're selling it to government entities. And so what you can see is that China's actually doing what they can to create some sort of soft landing for the property market. They don't want it to be as hot as what it is now, and they're happy for things to slow down, which is what you're seeing. But I don't think they're going to let it get out of control. And, you think about Evergrande, which got very close to the edge then, and you think about some of the other property developers that have been helped by the Chinese government. We're also hearing on the ground that the Chinese government has asked financial institutions to ease the lending standards a little bit to take pressure off. And so, I think they're going to navigate this period, albeit, you will see a bit of a gradual slowdown. Things that I find really interesting going on in China right now is how they're going to manage this COVID zero scenario and when they're going to open their country back up to the rest of the world. That is going to be something that's really interesting to see, considering, just next week, you've got Chinese New Year happening. It's going to be very interesting to see whether or not they're going to be able to continue with this COVID zero path that they're on. You've also got the Winter Olympic Games in the next couple of weeks as well in China, which will be interesting to see as well. But in terms of property and the property exposure there, our house view at the moment is that things are slowing down, but there are policy tools in place to make it a softer landing than what the market's currently viewing right now. And I think you will see them pull the stimulus levers and the policy levers that they've used in the past to help them sort of navigate this sort of period. So overall, if I think about our portfolio's exposure, we don't have a lot of direct exposure to China. We've got some indirect exposure with some copper companies and the like. We do have a little bit of bulks with things like BHP. But overall, we don't think it's going to be a crash landing for China.
It's an interesting one. It's obviously just such a large economy, and it's just, when we talk about that and we talk about the US, it's just, when we talk about direct and indirect, it's just like, is everything just indirect? It's just that big. So,
Australia's exposure in particular is massive to China, obviously, given commodities and energy and that sort of thing is such a big part of our market.
That's it. And the biggest thing is as well, too, for everyone who's viewing and listening is just, we obviously don't know. No one's got a crystal ball. It's just looking at the actual indicators, looking exactly what's going on in the economy. And, like Kyle was saying, what actual things are actually happening, not speculating on whatever, that Chinese buy of that sale and buy of that land is actually happening. It's not, this is where we want things to be based on. So I think the other one as well too is just to touch on is obviously this whole Russian potential invasion happening and like pandemics, no one likes wars. They're pretty frightening stuff. US has started to send over supplies and, they're talking about training drills on the border and stuff like that. I see oil prices have already kind of started to rise as well too, which is usually the case. Hearing about potential war puts shivers in anyone's, down anyone's spine. No one wants to be in wars. Potential ramifications. What are you guys hearing on the ground and whatnot?
I think the key thing from an investment standpoint is just thinking about the implications of sanctions coming from the US onto Russia. It's going to be interesting to see how Europe reacts to those sanctions. So right now, Europe has a problem in that gas is very expensive and energy in general in Europe is very expensive at the moment. They're actually very short on gas at the moment, which is something that they need. And so any sort of sanctions from the US, and this is what energy markets are reacting to, oil and gas markets, that will limit supply of oil and gas into the broader economy. And so, Russia, they're not a massive player, but, they'd be 5 to 10% of global energy supply, just in terms of when you think about 100 million barrels a day is generally global supply. So, they're big enough to make a difference, and any sort of sanctions on Russia will have an impact on those commodity prices and energy prices. So I think you've seen a little bit of that in the last few days, the oil price reacting to that. In terms of Australia, we've got some great exposures to that, to particularly to gas in our market with Santos. Santos, now that they've bought Oil Search, top 20 player, they would obviously benefit and have been benefiting from higher energy prices over the last 12 months. So, we think about that in terms of our exposure. We've already got energy exposure within our portfolio, so been benefiting from our thesis that you are going to see globally higher energy prices as a result of a lack of supply due to years of underinvestment in both oil and gas projects. Albeit at the same time, we're actually overweight EV materials, so electric vehicle materials as well. But I think you're going to see a bit of a cycle for both new energy materials and old energy materials as we try to navigate this transition. But short-term issues for energy markets if you see sanctions on Russia from the US.
Do you feel like when we're talking about this whole oil and stuff, and everyone knows that at one point in time, everyone wants to go to clean energy and we want to kind of get away from our oils and stuff. Do you find that short term, yes, there's going to be, this spike in this demand because they just need it now. But once again, this probably emphasizes, especially for like the likes of Europe and whatnot, that they just can't rely on these energy sources, that they need to be going to clean energy and they need to be moving to, diversify their energy sources because, there's always going to be problems wherever there's people. There's going to be confrontation. I think you lost the light.
I wasn't moving around enough, John. I've got to use my hands more.
That's it. So just around like energy, obviously, we're talking about energy, particular, obviously around gas and oil and stuff like that, but obviously the clean energy side as well too. Do you think that as well too is going to the governments, they're already committed to going down that side, but obviously short term, it's like, let's just power these countries. But it must go into the heads of, we've got to expand in these alternatives.
Yeah, absolutely. I mean, to be honest, we're bullish on old energy and new energy. So I'll touch on new energy first, and then we can cycle into old energy as well. In terms of new energy exposure, you just look at the demand forecasts for any sort of new energy materials. Let's take Linus, which specializes in rare earth materials. Now, rare earth materials are used in things like magnets, which are used in batteries, also used in things like wind turbines. One of the key inputs into that, and probably the most important exposure for Aussie companies like Linus is a material called NdPr, and again used in magnets. So you can't create an electric vehicle without magnets. You need these rare earths. And they're such a small part of the overall cost of building a wind turbine or building an electric vehicle. But the demand for these materials is so high that you've actually seen NdPr prices, move, bottom left to top right. You're sitting at around $130 a kilo today, and you're talking sort of 3x where it was 2 years ago. So what's driving that is huge demand for these new energy materials. And in Australia, we're really lucky that you can get some really high quality exposure to companies that are producing these assets right now today. So Linus is one that I mentioned before. You think about rare earth materials globally, 80 to 90% actually come out of China. And so Linus is actually one of the only major producers and suppliers of rare earth materials outside of China. And so countries like Japan, countries like the US are paying a premium to have security of these new energy materials that are going to be so important for the energy transition. Then you've got boring stuff like copper. Copper's used in the electrification of everything. Now, you're not talking 3x demand in the next 10 years like something like rare earths, but you are talking about 30% increase in demand for things like copper over the next 10 years. And where it becomes really interesting is on the supply side, because supply of copper is getting harder and harder to come by. And so as you open up that gap between demand and supply, the thing that needs to move is the price in order to incentivize new mines to come on board and new exploration, etc. So that's a bit on new energy. It's going to be massive. The whole world needs to transition to a new energy economy, and you're definitely going to see that over the next 30 years. So we're very bullish on that. But we're also bullish on the medium-term outlook for old energy. Now, this is something that we've done a lot of work on. And one of the things I find really interesting is going back to that 100 million barrels a day of supply and demand. In normal markets, 100 million barrels a day in terms of demand is what you'd expect for global energy demand. What you actually see is when you go out to 2030, it doesn't really change. It actually stays flat. So when you look at the underlying components, things do change. Around 20% of that demand is automobiles. And obviously with new electric vehicles coming on board, that starts to tail off. But then you've got things that are harder to replace. So you've got jet fuel, which is obviously hard to replace. You've got things like shipping, very, very hard to replace there. I suppose maybe nuclear could be a potential alternative, but there's not really any alternative right now in terms of those fuels. And then you've got things that you and I use every day. Things like oil are used in chemicals. So things like fertilizer used for agriculture, etc. They're used in plastics. The inputs are massive for oil, and gas is obviously predominantly used for energy. And so when you put it all together, demand is broadly staying flat over the next decade. But where things get really interesting is in supply, because energy markets have been underinvested in for the last 7 years. 2014 was the peak, and global oil and gas capex has fallen by around 60% since then. Now, really interesting fact about an oil well, it's all about using pressure. So you push water down into an oil well, you get oil that comes back up. So you need constant capex, maintenance capex and operational capex in order to keep that pressure and to keep that energy going. And if you don't continue to invest in an oil well, that well will deplete by around 5 to 7% per annum. And so because you've had this period of massive underinvestment in oil and gas projects globally, no exploration, no one wants to look for oil because, high cost projects, 20 years, and you've got this energy transition going on, but people have been underinvesting in maintenance CapEx. What you're seeing right now is a shortage of oil and gas to meet current and future demand right now. And that's why you've seen energy prices at elevated levels. And I do believe over the next 7 or so years, you're going to see higher energy prices in oil and gas markets as a result of these supply demand dynamics. And again, to put it into context for a company, before it was taken over, Oil Search, every $5 move in the price of oil, because gas is linked to the oil price, every $5 increase in the price of oil would result in $100 million free cash flow to Oil Search. And you've seen the oil price go from $40 18 months ago to $90 today. So we're talking 700 mil in free cash flow for that business. And so, you can get some good exposures in this energy transition. To your point before, these big changes, this uncertainty creates opportunities, and you can actually maximize those opportunities on both sides of the coin as an investor, looking for those new energy opportunities, acknowledging that the world needs to move, but also, benefiting in terms of, the massive opportunity in old energy at the moment. And so, we'd be playing that through something like a Santos right now in our current portfolio.
Very, very interesting. Very, very interesting. And great to see how things impacting on very different ways. And obviously the new energy and old energy and all of these particular parts. Now,
and what a great country Australia is to have exposure across the spectrum as well. Really lucky.
It is, and we're a very good country in regards to how diverse we are, and obviously what we've got in our arsenal from businesses, both from a goods and from a services base. We're talking about earlier on about some of the companies like Qantas and whatnot, and obviously now we're talking about even around Santos and whatnot. So it's a very, very good country, and they call it the lucky country for multiple reasons. But Cole, let's now just kind of circle back, and we're talking about just like 2022 and your feeling around this. Maybe just your general feeling about what 2022 kind of feels like. What Firetrail are kind of anticipating is in regards to what they're anticipating in their investment decisions. Are they being very cautious? Do they think that volatility is going to continue to be around? And just what 2022 looks like. Just trying to keep it short term.
Yep, for sure. So a couple of key risks. Number one, you've mentioned the biggest risk, which is inflation and the Fed having a misstep. Very hard to predict that, almost impossible, because I don't have a direct line to Jay Powell. I don't think he'd tell me even if I did. But that to me is the biggest risk for growth assets and alternative sort of assets. And so it'll be interesting to see how that plays out. I don't actually think there needs to be a scenario where there's a market sell-off as a result of rising rates. I actually think what you can see is more of a rotation in equity markets towards companies that have been traditionally undervalued, and reopening sort of companies that are exposed to reopening economies, and away from really high valuation, low profitability businesses. You've already seen a lot of that happening at the moment. You spoke to quality businesses before. These companies that have very high valuations but very low to no profitability, are sort of falling into that higher risk bucket for me at the moment. I think businesses that have proven earnings, high quality earnings right now, those businesses should be able to navigate this sort of period. And then there's a big opportunity, I believe, in companies that are going to benefit from economies reopening. Now, you've already seen demand for goods has been very elevated. What you haven't seen so far is demand for services start to come back. And so potentially you see a bit of a rotation in the market away from companies selling goods, exposed to inflation, higher wages, etc., because you might see some earnings pressure coming through. But companies exposed to services, where you can see demand coming back strongly, could be in a very good position over the next 12 to 24 months. The other thing I think will play out is I think this is going to be a stock pickers market. Stock pickers like Firetrail, like some of the other investment managers you talk to, markets don't like uncertainty and volatility, but stock pickers love it because it just creates great opportunities to buy companies that we've been looking at material discounts. So, we've been very active in the portfolio over the last 12 months. We feel like we've got the right sort of positioning for the current sort of environment. Markets could be up or down over the next 12 months. I can't look into a crystal ball and give you that answer, but I think, there's enough in expectations that we can get through this current period. But right now we are seeing some really compelling investment opportunities. I've mentioned a couple of them before, but happy to sort of dig into what we're seeing, both in companies that are domestically focused and exposed, but also companies that are taking market share offshore as well. Aussie companies, with offshore exposure, finding big opportunities in big markets like the US, etc.
And I think the biggest thing is, Kyle, is that we don't know what's going to happen tomorrow. And what we try to talk about here is about, emotions and making sure you keep yourself in check, sticking to the plan. There's a hell of a lot of noise, but in all noise, there's opportunities as well. Okay. And trying to cut through that noise and find those opportunities is where successful investors continue to play. And so controlling the emotions, sticking to the plan, looking for the opportunities as they present themselves is very, very important. Kyle, it's been an absolute pleasure for you to jump on today. I really appreciate your time. For everyone who's watching or viewing, please, all of the information that we've told you today is of a general nature. Please do not go out there and execute these on your own. Seek professional financial advice before acting on any of this as well. But Kyle, thanks, mate, for jumping on. I really appreciate your time, and thank you very much for your insights.
Thanks, John. Good to speak to you.